Hi everybody, this is Roxy from the trading floor. I want to do a quick Hi everybody, this is Roxy from the trading floor. I want to do a quick video for you guys on the concept of liquidity on the lower time frame. It's really not different than what's done on the higher time frame, but I want to show you real quick how I'm using it for targeting my take profits. Liquidity, like any other subject, can be made to be as complicated or as simple as you want it to be. Okay, and I want it to be simple for you guys. So liquidity at its simplest is the locations where people's stop losses are located, as well as where, for example, breakout traders place their breakout trades. So let's give a few examples here. So liquidity is going to rest underneath lows here, underneath here, here, and then you see it makes a new high here. So this is your new high. And then you can also have trend line liquidity like this, all of these little points here making its way up. You'll also have large pools of liquidity, like here where you have these equal highs. This is a large pool of liquidity right here. Basically, the concept is that you have pools of liquidity, the stop losses for people, for example, here who have gone short, their stop losses rest here. People who have gone long, their stop losses rest here, here, here. All along here, you've got people's stop losses, those who jumped in the market to go long, and people who jumped in the market going short have their stop losses here. The market is looking for pools of liquidity in order to continue in the direction that it wants to go. As we all know, a market can only move so long in one direction before it's going to have to put in a pullback. Okay, so it moves up, down, okay, and it's moving its way upward. This trend line liquidity right here was perfect. This would be London session open for me. So here you can see that it moved downward sharply. What did it gain along this move downward? It gained all of the liquidity. All of the stop losses were run of anybody who had gone long along here and was still holding their trade. Now, what is it trying to do? It's trying to gain liquidity in order to continue the move. So we've moved upward and we moved downward. We've gained some of the liquidity from the stop losses here, and then it's able to move upward again. And as it moves upward again, what is it doing? It's targeting and taking out the liquidity here. So you can see that the movement upward came just above and snagged all of the liquidity right in here. Now as it moves upward, it's snagging liquidity of stop losses that are placed above these locations off to here. I use that, for example, if I were to place a trade, let's say that I've seen the market turn over and I believe that it's now moving in a bearish direction, so downward. I get into a trade right in here, for example, and let's say I put my stop loss up here. Now, where am I going to target? I can target one of two spots. I can target right in here, so all the liquidity that's resting in here for everybody who went long on this movement. I can then take it short, targeting this location right here where you can see it runs downward into here. I can also look to target the liquidity right in this area for everybody who put their stop losses below here expecting it to go long. And as you can see, the market ran down right down in here. So if I targeted the liquidity of the stop losses right here, what do you know? Market went down, perfectly tagged that liquidity out before it continued on in its intended direction. Just to make it clear, I'm going to go ahead and run a line across here so you can see right here. I want to make that very clear what it was targeting, the lows here. Okay, the low here, that's what it ran right here in order to grab that liquidity. You can do the same thing running along here. These highs, what did it run? It ran liquidity here. These highs basically equal high of anybody who put their stop loss, like here, for example, right above that wick, run it across. What did it run? Grab that liquidity. Where did it go? Continue the movement down. Frequently a market, as it's moving, okay, it will consolidate. What is consolidation? It's a building of liquidity. Everybody going short gets run. Everybody going long, it gets run as well as the market drops through. So that's a lot of times what you see in a rangy consolidated market. It's frequently building liquidity up, and people that went long here, and I'll show you right here, right along here, ran liquidity. Okay, came down, ran this liquidity. As you can see here, it's targeting liquidity pools and it's running those to accumulate liquidity in order to move the market in its intended direction. Liquidity can be as complicated or as simple as you want it to be. For me, I keep it really simple. I just picture all of these highs and lows, and I know that there's people stop losses sitting there. So if I believe the market is running in a certain direction, where can I put my targets? I'm going to target the most likely location where the market is moving in order to gain more liquidity to continue on. I hope that helps. Thank you for joining me. Hi, everyone. This is Roxy from the trading floor, and I want to teach you guys how to spot divergences and the importance of using them and how they can really add to your trading, adding that extra confluence to build confidence in the trades that you take. These are especially important for me in trading. I am more of a trend trader, and for me, I use divergences heavily as a confluence for taking continuation trades. So let's dive in. A divergence is the difference between using an oscillator and price. So when price, for example, makes a lower low, but your oscillator makes a higher low, that is a divergence, the difference between the two. There are both bullish divergences and bearish divergences. Some where when you see them on the oscillator on the bottom, that is going to be a bullish divergence. It's going to push price upward. So you get that reversal that pushes price upward. If you spot it on the top of your oscillator, it is going to push price downward. You're going to have a reversal that pushes price downward. Not all divergences are going to be of the same quality. They will all play out, but to varying degrees. That is why at the beginning I mentioned that I use continuation divergence, also known as a hidden divergence. These are the divergences that support pullback continuation trades with trend. Divergences again allow you to have an additional confluence to build confidence in the trades and analysis that you have done on your chart. Here you can see that price moves in legs. It doesn't just move straight down one way and straight up another. In this example, I want to point out where you can spot bearish divergences and bullish divergences. Price is making a lower low, lower high, lower low, lower high. When you have that type of movement, you're going to be looking for bearish continuation divergences on each one of the pullbacks. Where you want to spot, for example, a reversal divergence pattern is, for example, when you notice that you have a double bottom, also known as a W pattern. When you have a double bottom, this is a great time to look at your oscillators and see if you also have a divergence pattern. That divergence pattern can give you that additional confluence and confidence to take that reversal trade, especially if it was from a strong area of support. Once the reversal has played out, you can look for bullish continuation divergences. Here you can see the lower lows and lower highs, lower low, lower high. On these lower highs, you're going to be looking for continuation divergences. On the lows, you would be looking for a reversal divergence if you are counter trend trading. As you learn to add more confluences to your trading, you may be looking to spot patterns in your charts. Here you have a head and shoulders pattern. You would be looking for reversal divergences in this location. For example, from this point to this point, you may spot that although price moved lower, your oscillator moved higher. That would be a divergence. You can also look from this point to this point on the pullback. And you will be looking for continuation divergences as price continues to make higher highs and higher lows. Now, here we just have a naked chart. These are just your regular candlesticks. And you can do this with Heikin-Ashi candlesticks as well, but I'm going to show you regular candlesticks since that's what I use. Again, these can be done on any time frame and any market. Now, I'm going to show you several different time frames and several different markets along the way. I typically trade a 1 minute NASDAQ US 100, so I'm going to go ahead and start there. Let's add an oscillator. I like to add two different oscillators because they can show divergences a little differently. Sometimes you'll spot it on one and not on the other. The first one we're going to add is the TSI, True Strength Index by Everget, to our chart. And the second one we're going to add is the Ultimate Oscillator, which is a default indicator. This one is the TSI, and this one is the Ultimate Oscillator. Now, for the TSI, the settings are 6, 13, and 4. Okay, on default settings for your ultimate oscillator. Okay, show you how to set those. TSI, long length 6, short length 13, signal length 4. Ultimate oscillator, UO, default settings. Now, as we saw on that chart before, we're looking for where price is moving downward, oscillators moving upward, or where price is moved upward, oscillators moving downward. That's what we're looking for a divergence. Let's see what we can spot here. Here we have had price make a large push up, and then we get a pull back. These are the types of trades, like I said, when I'm trading with trend, we've had a higher high. Now we're looking for that higher low, and I want to see if there's a divergence here to support this trade. So for a divergence, we're going to look back here. We're going to connect these two locations, and then we're going to come down here and we're going to look. The oscillator, the TSI, made a lower low here, where the price made a higher low. Now on the ultimate oscillator, you can see here, it went just straight across. That is also a divergence. So same level, also a divergence. Now I had mentioned that I like to take with trend divergences, continuation divergences, also known as hidden divergences. You can also take a trade where it's a reversal. So here we have a double top, 1, 2, double top, also known as an M pattern. Up, down, up, down. That pattern frequently has a divergence with it. Let's see if we have a divergence on here. Here on the ultimate oscillator, you can see that we have this peak to this peak, and this one is lower. You can see that divergence as well. On the bottom, pushing price upward. Over here, on the top, pushing price downward. Small one here, double top, again, right here. Looking for with trend. If we consider that this has created a reversal and has passed through previous support right here, then I'm going to be looking for where the oscillator is pushing higher and price is still continuing to push lower. Okay, so higher here, lower here. That gives me some confidence to be able to take that trade. Again, lower here, down here, higher over to here. That's what assists me in taking continuation trades. Frequently asked question, do these occur on other time frames? Because people see me trade 1 minute and they think, well, but I trade the 15-minute or the 1 hour. Is this really relevant there? Yes, it is. Also relevant on other markets. Let's dive into another time frame and another market. Now we're on the US 30 1-hour chart, and here you can see that we have made a lower low, lower high, lower low, lower high, lower low. Then we get this higher high, higher low. We have had a reversal of trend direction in this area. So let's look for some continuation divergences. Here we can see that the oscillator pushed higher, price pushed lower. Here, oscillator pushed higher. That would be a continuation divergence. Oscillator on the bottom pushes price up. Again, going to be looking for where the oscillator moved down and price made a little bit of a pullback, but did not break the support location. So from here over to here, from here to here, get another continuation push. From here, right over here, up into right here, and from here over to here, and we get another push up. Okay, so these are your continuation divergences supporting your with trend trading. Now let's see if we can spot a few reversal divergences on this chart as well. I like these from a double top or a double bottom. Here we have a double top, also known as a M pattern, typically traded breaking the neckline right here. If we look here, double top, we have our divergence playing out right here. And you can see price fell away, and that was an actual reversal pattern that played out. Here we're on a Forex pair, specifically the Australian dollar versus the US dollar, also known as AUD USD. Here it pulls back into this support, and we'll come down here and look. We can see that the oscillator has shown us the oscillator dropped much further, and price did not mirror that same movement. Again, over here, looking at this, down to here, you can see both oscillators show you this divergence. Underneath, the oscillator pushes price upward. Here, we have a very nice continuation divergence. This is Roxy from the trading floor, and I want to teach you guys how to spot divergences and the importance of using them and how they can really add to your trading, adding that extra confluence to build confidence in the trades that you take. These are especially important for me in trading. I am more of a trend trader, and for me, I use divergences heavily as a confluence for taking continuation trades. So let's dive in. A divergence is the difference between using an oscillator and price. So $1 versus pushed trading, notion trade, or it's a reversal divergence. You can see that these same divergences occur on multiple different time frames.
All right, welcome back to another educational video. My name is Artie, the creator of the Moving Average YouTube channel, and today we're going to be covering using a trailing stop loss. Now, getting right into it, manually adjusting your stop loss is not something that I recommend if you are in the early stages of your trading career. It's better to just set your trade and forget about it. There are multiple ways to trail a stop loss, and the most common is to just have it above or below the 21 moving average. Now, the first example that I want to cover is step levels. This is an automation. So for example, you would buy on Euro USD, whatever position size you want, but your stop loss is 10 pips and your take profit is 20 pips. If you set a trailing step of 10 pips, that means that once your trade gets to be 10 pips in profit, then your stop loss will automatically adjust to 10 pips below the current price. And if it keeps rising, that stop loss will keep rising and stay 10 pips behind it. But once the price starts coming back down, that previously set stop loss at 10 pips will no longer move, and then your position will close once that adjusting floating stop loss gets hit. Now, manually adjusting. This method is better because it allows for subjective pullback identification. What that means is that when price is trending in a certain direction and has a pullback and then a continuation, those are very subjective. You need to know price action, you need to know market structure, and you kind of just have to have a good idea of what the price action on that currency pair or asset that you're trading does. Price will move up and down and pull back and then continue with the trend. Setting your stop loss to the previous swing low or the previous swing high is what is recommended. Now, let's take a look at some examples. Okay, let's go over this example. So currently we are in an uptrend on Australian dollar, US dollar. We had a little three-line strike right here. This did not reject off of the 21, but maybe like the 7 if we were to change that moving average. Regardless, let us get into a long position at the close of that candle, and our stop loss could be below the previous swing low, or if you guys want to stay nice and comfortable, you can keep it at 10 pips. Now, let's just say for the sake of this example, we're going to do 10 pips and 20 pip take profit. Now, when looking at a trailing stop loss, essentially, this is going to be your 2-to-1 risk to reward ratio. So I'm pretty convinced and under the impression that once you get to a 1-to-1 on your risk to reward, you should move your stop loss to break even. That means that once you get 10 pips in profit, your stop loss should be break even because then it's a zero risk trade. Now, once you do start getting into profit, and let's say that you have moved your stop loss to break even, you are essentially keeping track of market structure. You are looking at these low points and using those to judge your stop loss. Because we know when market structure is broken, failure to make a higher high and making a lower low, then the price might either consolidate or make a trend reversal. So as you have manually moved your stop loss to break even already, and you are 10 pips in profit, what you can do now to get the most out of your trade is slowly start moving your stop loss to these higher lows. Once it breaks past this one, it makes a new low and starts going up. That is your new stop loss. Again, went up, came down, that is your new stop loss. Price started to go up and hit your trailing stop loss. If you do this and you keep your trailing stop loss too tight, you will get closed out of a position like it did right here. What you can also do instead of every single one of these higher lows is essentially keep your stop loss along the 21 moving average. Monitoring your trade instead of just letting it play out is far more stressful and far more difficult. But when you are swing trading, this could be highly beneficial because you could get a massive move out of it and hold a trade for multiple days or weeks. But if you're scalping and you've already decided on your risk to reward ratio, I think this would be an easier option to just let it play out. But if you want to do trailing stop losses, this is how you should do it. Okay, now looking at this exact same trade on MT4, you can see that we got a 3-line strike right here on the charts. But on MT4, because of the price difference, it did not pop up, and this is what I was watching. So I got into this trade extremely late. This was the original 3-line strike, and I got in right here 2 candles later on the 1-minute chart. So using the risk calculator, having my stop loss below the swing low with a 1 to 2 risk to reward, this is how it looks now. There's one of 2 ways to do a trailing stop loss on the MT4 platform. If you already set your position with a stop loss and a take profit, you can right click the active trade and click on the option called trailing stop and either set it at 50 to do a trailing stop loss on the MT4 platform. If you already set your position with a stop loss and a take profit, you can right click the active trade. Already set your position with a stop loss and a take profit. You can right click the active trade. Looks now. There's one of 2 ways to do a trailing stop loss on the MT4 platform. If you already set your position with a stop loss and a take profit, you can right click the active trade and click on the option called trailing stop and either set it at 15, 20, 25, 30, 35, 40, 45, or 50 points or make custom. This 15 points is not 15 pips. It is 1.5 pips. So if you have a 50-point stop loss on a Forex pair, it's going to keep your stop loss 5 pips. So the price must get 5 pips above your entry price before it adjusts. The second way of doing it is clicking your already active stop loss and dragging it to modify. So you can see here, I can drag this and move it wherever I would like. So my current stop loss is here. The price is currently above my entry. Maybe I might feel a little bit more comfortable and lose less money on my trade if I move my stop loss to this previous swing. So previously it was here and I just moved it up 1 swing. So now with price going in my direction, and I originally risked $500 for this trade, which is 1% on a $50,000 account, I'm now risking about half that amount. So if it does hit my stop loss, I've only lost 200 while it's still going in my direction. So this trailing stop loss is also known as a trailing step because every time price goes up 10 pips, your stop loss will go up 10 pips. So it's essentially like a ladder. Okay, so continuing on with a trailing stop loss using the TTF risk calculator. Right here you see a button that says TS. That is for trailing stop. The first box is how much the price must go up or down in your specified direction in order for the trailing stop loss to start generating. Once it gets to that point, then your trailing stop loss will be specified to the second box, so 10 pips. So once the price goes up 10 pips, your trailing stop loss will now remain 10 pips behind the current price action. So currently on this position, our entry price was 70092 and it is at 70230. So we could actually set our trailing stop loss right now because it is 10 pips above the entry level, and we can maintain a 10 pip stop loss at this point because it's kind of getting a little bit of resistance, which is also a previous high point. So what you need to do is in the drop down menu, select the trade that you have open and then just click TS. And as you can see, my stop loss line right here is now going to stay at this level. And if price keeps dropping, which would be exactly 10 pips, my trailing stop loss would be hit. If it continues up and up and up and up, this will continue to go up with that until it has retraced 10 pips. See how as the price moved up, the stop loss moved up? This will continue to go up and stay 10 pips to this candle or wherever the price goes. Hopefully you guys got some good information out of this. If you want to, please go watch Jay's video. That is in the Get Smarter section, just a little ways above this video. Fuck yeah. Take profit hit during that shit too. Well, I really hope that helped you guys. If you want some further information on this topic, please just ask in the general chat or a specific chat in the Discord community. We are more than happy to help you guys out with this. Also, make sure that you check out Jay's video. It's a few videos above this one in the Get Smarter section. Thanks so much for watching, and we will see you in the next one. All right, guys, back by popular demand. You guys want to learn how to grow a small Forex account. I've done it, so I'm going to teach you how to do this, but I want to offer a few caveats and warnings before we get into this. One, this is very risky, and I do not recommend it for anyone. The level of stress and anxiety and pressure that this puts on you is way more than most people can handle. The second thing is that it teaches extremely bad habits and may cause more losses down the road when you stop doing this challenge. Keeping in mind the fact that these bad habits are extremely hard to unlearn. Now, because you're growing a small account and you're risking a very high percentage, you can blow your small Forex account within 1 to 3 trades depending on your stop loss. Back-to-back losses are very common, so you need to be aware that this is very, very likely. Also, this is not sustainable long term. This is only for people that have a very little amount of money, and this is the only way that they can think of how to grow it. But if you only have $20 and that's the only thing that you can do, you will fail at this because you need to be prepared to lose anywhere from $400 to $1,000 trying this, because you will inherently fail numerous times, just as I did. Now that all those warnings are out of the way and you guys have a clear understanding of what I'm explaining to you, like, don't take this lightly. You will lose 100% when first trying this. Let's get into it. The key to growing a small Forex account is scalping, not swing trading. You want to be in and out of your positions with tight stop losses. Those tight stop losses are found with good entry points. A good entry point is any trade that has 3 to 4 confluences that line up, giving you an indication that this trade will play out in your favor. The more confluences you have, the more confidence you can have in your trade. Now, I'm going to give you guys my way of trading because this is what has worked for me. There are numerous other strategies that you can do and grow a small Forex account. I'm just giving you mine so that you can have an understanding of the confluences I was looking for and how I set up each trade. My confluences were the price must be in a strong trend up or down, meaning the 200 moving average, the 50 moving average, and the 21 moving average are in order. You guys have obviously seen this on my YouTube channel because I talk about it all the time. The next confluence that I want is a 3-line strike candle formation. The next confluence is going to be a rejection off of or very close to the 21 moving average. This is subjective. And the bonus confluence, but it is not necessary, is getting a hidden divergence on the RSI. So a bullish 3-line strike looks like this. Price is going up nice. We have the 21 moving average, the 50 moving average, and the 200 moving average all lined up, showing nice positive bullish momentum. Price comes down to get very close to the 21 moving average, and we get a huge rejection candle off of it. That is 3 bearish candles and 1 bullish candle. The bullish candle is with the trend. We enter at the close of the candle. We wait for the candle to close. This is on a 5-minute time frame. So this is your entry, and your stop loss is going to be below that candle. In this specific scenario, it was 9 pips. It is only going to be dependent on the length of this candle. You will not take a 3-line strike if the candle is 20 pips long. It's too risky. You want the 3-line strike to either go halfway through the previous 3 candles or all the way to the top of it. And your take profit is going to be 20 pips. I have 21 pips just to cover the spread of the trade. Now the opposite, a bearish movement with a 3-line strike, looks exactly the same, just everything's flipped. We have our 200, we have our 50, and we have our 21. They are all in consecutive order, just to the downside. We get a rejection off of the 21 moving average, 3 candles up, 1 rejecting off of it. That is our entry point. With this specific example, it was a 7 pip stop loss and again a 21 pip take profit. When the momentum is strong and all the moving averages are lined up, the likelihood of the price continuing in that direction is high. This is why I like this setup, and it's only a few confluences. The reason I explained it this way is because it's the simple way that I'm accustomed to trading. This is how I learned how to trade. This is the strategy that works best for me. There are numerous different strategies that can be used for this as long as they have tight stop losses and quick exits. You don't want to be trying to grow a small Forex account on a 100 pip move. Ideally, you want to stay with the spreadsheet that we have provided for you titled the 20 pip challenge, which you can find linked next to this video. There is, however, an alternative way to do this if a 20 pip movement is too large of a move to get, depending on what price is doing. Sometimes 20 pips is too far away. Another warning, huge warning here. This is not recommended. This makes it even more reckless. What you can do if you don't see the price moving another 20 pips from where it is right now, opening 2 identical positions at the same time with the same stop loss and each with a take profit of 11 pips. So that if the price moves in your direction, both trades will automatically close at your take profit level of 11 pips, and together those 2 trades will have scored you 22 pips. I have 22 instead of 20 just to cover the spread of each trade. Keep in mind though, this is why it's not recommended. If you lose, you will lose 2 trades, and in our previous example right here, we had a 7 pip stop loss, and with 2 trades, that will add up to 14 pips as a loss, not just getting the 1. So if you're going to do this, stick to the 1 and try to get 20 pips. The risk to reward is far better. Now, the original way that this spreadsheet that we offer you guys as part of your membership is set up is having a specific risk percentage. So as you can see on the chart, the loss of the first trade was $4.51, and a 30% profit goal gets you $6. So the easiest way to do this is just follow what the spreadsheet has. This is your lot sizes. These are the pips that you're looking for. And if you do all of these, you'll start with 20 bucks and you'll take it all the way to $52,399.91. But if you're using the adjusted method where your trade size stays the same as it's shown on the chart right here, where you're still looking for 20 pips, but your stop loss is at the end of the entry candle, then you will lose less when you do lose. So instead of having like a 10 pip stop loss or whatever, having a 7 pip stop loss will have you risking less money with the same profit goal, essentially a higher risk to reward ratio. Now, just to clarify this, again, it's super, super hard and you're gonna lose a bunch of times. This took me 18 failed attempts before I started getting into the other levels. Like I would get 1, 2, 3 and then lose. 1, 2, lose. 18 times. So if you think about that, $20 times 18 is nearly $400 of losses, which for most people is a lot of money and is gut-wrenching to get non-stop losses. You really have to have a lot of mental fortitude to deal with that. Then once the ball did get rolling and I started to get into these levels, I would go up 3, down 2, up 5, down 4, and it was just constantly a battle to get to the end of this, which took me approximately 7 months to finish. I learned a lot from it, and it formed bad habits which I still carry with me to this day. Seriously, over risking all of the things that I was able to do in this sometimes trickle into my normal day trading where I have proper risk management, but I just make bad decisions because of the habits that were formed while doing this. And I know people are going to ask this, so I have to say it. You cannot do this with indices. You are looking for pips, and as we just covered in a previous video, pips and points are not the same. This small Forex account challenge is only growing a small Forex account, not a small indices account. Okay? So if you ask, you will be put in timeout for 10 minutes. And that's all there is to know. If you guys have no other options and growing a small Forex account is the only thing that you can do, go for it. But what I would do before risking your own money is try to do this on a demo account. Demo accounts are risk-free. You get a lot of practice from it. And if you can pass this 20 pip challenge and grow a small Forex account on a demo account, then do it in real life, you're golden. Again, and if you guys have any questions about this, please feel free to ask me in the Discord community. I'm happy to help people on their journey. Thanks for watching, and we'll see you in the next one.